In this video, we'll consider some issues around saving for retirement, and then how taxes will impact how much money you'll actually have available to you from those accounts when it comes time to spend the money. The number one concern most clients come to us with is, how much do I need to save for my retirement? And of course the answer is, it depends. But more often than you might think, some people are oversaving. That means they may be sacrificing living a bigger life today, because without knowing their target amount for retirement and all the factors that go into it, fear leads them to saving too much. When we start to look at the question of how much money you need to save for retirement, part of the answer for you will depend on where you plan to save that money. So let's look at a few common types of accounts or vehicles where you might be saving for retirement. Let's start with IRAs, or individual retirement accounts, both the traditional and the Roth. Sometimes the difference between a traditional and a Roth IRA is confusing for people, and I'll touch on some of the important differences on the next slide. As of 2022, individual retirement accounts allow you to save $6,000 per year with a catch-up provision of an additional $1,000 if you're 50 years old or older. Now, these limits tend to increase annually, so if you're watching this video after 2022, the numbers on this slide may have changed, but the concepts remain the same. Now, you have to actually earn income or qualify for a spousal IRA in order to contribute to an IRA. So if you make less than the contribution limit for the year, you can only put into your IRA as much money as you earned for that year. And a spousal IRA is meant for married couples. So under certain circumstances, it allows a spouse who is maybe not working outside the home or working in a low-paying position to open their own traditional or Roth IRA. But you may determine that $6,000 or $7,000 invested per year won't get you to what it means to you to be saving enough for your retirement goals. If you're fortunate enough to work somewhere that offers a 401k plan, you have some definite advantages when it comes to retirement savings. And while I listed a 401k plan on the slide, I'm also talking about 403b plans, which you see a lot for people who work for nonprofit organizations and educational institutions, and also about 457 plans, which tend to be for government employees. So one of the biggest advantages of a workplace plan like a 401k is that your employer may match the contribution that you put in up to a certain limit. And the matching scheme used will depend on the employer. For example, your company may say they'll match you 100% or dollar for every dollar that you contribute to your own plan up to 3% of your income. That means if you make $100,000 per year and have $3,000 voluntarily withheld from your paycheck for the year to go into your 401k plan, your employer matching scheme turns that $3,000 into a $6,000 contribution for you for the year. That's $3,000 from you plus $3,000 from your employer. But again, maybe $6,000 of savings per year isn't going to get you to the amount you need for a carefree retirement. Which brings me to one of the other big advantages of a 401k plan. If you're eligible, a 401k allows you to put away up to $20,500 for the year towards your retirement, with an additional catch-up provision of $6,500 if you're 50 years old or older, for a potential total of $27,000 for the year. And again, these are the 2022 limits. And finally, let's talk about the health savings accounts, or HSAs. HSAs aren't traditionally thought of as retirement accounts, but they can be pretty powerful resources when you do retire. And that's because one of the fastest inflating expenses for most people in retirement is the cost of healthcare. If you're eligible for an HSA, and there are very specific rules for eligibility that I won't go into here, you could save up to $3,650 per year as a single person, and $7,300 if you're married or have a family. There's also a catch-up provision of an additional $1,000 if you're over 55. Notice the catch-up begins at age 55, not at 50 like with the IRAs and the workplace plans like the 401k, 403b, and 457. So the strategy you can use with the HSA is that you can put away money in that investment account but not use it right away. So you instead pay out of pocket for your healthcare expenses now, letting that investment account grow in value over time to be used after you retire when you have more and higher healthcare costs. Let's take a look at some specifics of why you might use one of the retirement savings vehicles we just talked about over another based on the tax implications. This slide presents a hypothetical situation, and in this example, we're going to say you save about $583 per month for retirement, which works out to about $7,000 per year. You do this for 30 years with a fairly modest 6% return on your investment, and let's say you're currently in the 22% income tax bracket. In the first bar, we're looking at a taxable investment account, or what you might call a regular brokerage account. After 30 years of investing, you now start taking money out of it to live on for your retirement. The money you take out will be taxed at the applicable capital gains rate at that point in your life. And right now, the applicable long-term capital gains rate for the amount in this example is at the maximum rate of 20%. So the actual money you'll have for your retirement from this type of account, after taxes are taken into account, is $503,047. Now looking over at the next two columns, you see the impact of taxes if you instead save your retirement funds in an IRA. Now you can see that the amount of money earned in an IRA is higher than for a regular brokerage account, and the amount you get from a Roth is even higher than when you get from a traditional. So I said earlier that I'd talk about the difference between the two individual retirement accounts, and here's where it really matters. Say by the time you reach retirement, you've done some solid financial planning and investing, things went well for you, and instead of the 22% tax bracket you started in, you're now in the 25% income tax bracket. The money that you put into a traditional IRA was pre-tax money, meaning not yet taxed. So when you take the money out for retirement, the IRS considers that money you put in and any money you earned on it over the years as income at that point, and they want you to pay your tax bill. And you have to pay up at your higher 25% income tax bracket. The money you put into a Roth IRA, on the other hand, is post-tax, meaning you pay tax on your earnings at the point in time that you put them into your account and at your original 22% income tax bracket rate. Therefore, when you take your Roth IRA money out at retirement, your distributions come out with a tax bill already paid in advance and at that lower 22% rate. That's why in our example here, you end up with more money available in your Roth IRA than in your traditional. And last, let's again look at our favorite, the health savings account. If you use the strategy we talked about earlier, about paying for your healthcare expenses out of pocket during your working years, and leaving your HSA money in your account until you retire, you get the tax benefits of both the Roth and traditional IRAs. Meaning the money goes in pre-tax, so not taxed when you add money to your account, and when you take it out, neither the original money you put in nor any earnings on that money are taxed if you use the money exclusively for healthcare expenses. Please reach out to us if you're interested in learning even more about the right retirement planning strategies for you.